Welcome to the InterMarket Analysis Update. This is a video that I do every week where I look at two main things. We look at S&P 500 valuation. We look at it on a historical basis, what it's already been, and then we look at it on a forward basis to see how is the market valued right now. And then we look outside of the S&P 500 at other indexes, other sectors, even other markets, because sometimes we can get some insight as to what's happening with the S&P based on what may be happening or not happening in a different market. This is being prepared for Monday, May 6th. The first area is S&P 500 valuation. This is looking historically. And what we use to measure this is a thing called the price to earnings ratio, or PE ratio. And we have different numbers, 10, 15, and 20. When we're at 20 or above, which is where we are at now, when we've been at this level for quite a while, that means on a historical basis, the market is considered to be expensive or overvalued. We would have to come all the way down to this red line to be back to a more normal reading. But you can also see what is normal is we can spend years above this red dashed line. So we don't use this for a timing mechanism. We don't use this really to make decisions. We look at this more just to get some insight as to what's actually happening in the S&P. And then down below, I have the spread between the current price of the S&P and the PE ratio of 20. When we're above 0, that just means that we're expensive on a historical basis. We can also compare that with different events that have happened and what the ratios were at that time. But then there's another thing we look at that was developed by Robert Shiller. This takes more of a smoothed approach over a period of time. And right now, this reading is coming in at 34.05. Well, to get some context, we can look at a historical chart going back well into the 1800s. We can also look at the median and the mean here, where we're getting a reading of between 16 and 17. Well, the latest reading here is 34.05. So we're double what the median and the mean has been. So according to this study, stocks are considered to be expensive, but they've been expensive for quite a while. So this can last for a lengthy period of time. The market doesn't do that. They look forward. And instead of just tracking the S&P 500 forward earnings, I also track the mid caps and the small caps. The red line is the S&P 500 forward PE ratio, and we're just a little bit above 20. So we're slightly expensive, even looking out into the future. We also look at the mid caps and small caps, where the mid caps are coming in a little bit over 15, and the small caps are a little bit over 14. So they're more fairly valued right now, even looking forward. Then we look at a thing called growth to value. Growth is when you want to buy low and sell high. Value is when the market becomes more defensive. And these are stocks that tend to stand up better when the market's under pressure. Also, when the economy is doing a little bit worse and there's some inflationary pressures, folks may jump over into value stocks. So we look first at just a pure growth index, where we can see that this is an uptrend. It has been falling back, but it's been chopping sideways, but showing some improvement lately. Then we look at a pure value index, which is also doing a little bit better here. Just looking at the chart by itself, we're coming back up close to its 50-day moving average after it had been seeing a little bit of recent weakness. Where we really get some insight is when we do ratios between the two. In a good, solid environment, we want to see growth outperforming value. In more of a defensive environment, meaning the market is going sideways to down, we would see value outperforming growth. Back in 2022, we saw where growth was really outperforming, value was really outperforming growth. Then when we switched back over and we're in the bull market that we're in now, we can see where growth is outperforming value, and it's still outperforming on a ratio basis. Now, on top, I have growth to value. On the bottom, I have value to growth. This just gives us a little bit of insight. We might see things a little different way by looking in inverted charts. Also, you'll notice that the moving average is a little bit offset when they crossed with each other, because these things are calculated in a little different way. And then I have a number of different studies that compare growth with value. This is looking at some ETFs where growth is still outperforming value. This is an inversion of that same chart where value is underperforming growth. Here's another look at the pure growth indexes that we already looked at, but this is a longer term chart, still showing that growth is outperforming value. It had been seeing some weakness as the market was getting more defensive and had been under pressure, but we're starting to turn a little bit more positive now. And so we're seeing growth show some improvement. We also look at here where value is underperforming growth. It came right up to this moving average. That was resistance and then has been coming back down. That just means that growth is outperforming value. Then we're also looking here, showing that growth is outperforming value on this chart as well. And then we look at a couple of ETFs. And I've been showing this a lot in the daily videos because we came down right to this 250 period moving average. And so far, we've been bouncing up off of that as things have been turning back a little more positive. Here's an inverse of that same chart showing how value almost made it up. See how it almost came to that 250 period moving average? That's why I use a lot of inverted charts here. It's not showing quite the same thing, but now value has been coming back down compared to growth. Then we look at small cap growth of value, where it's been declining, chopping sideways, could be showing some signs of improvement. Longer term, we're still in an uptrend. Mid cap growth of value, also some weakness as the market was under pressure. Could be showing some improvement, but still in a longer term uptrend. This is S&P growth of value, looking at the ratio where we are bouncing back up, but we still have a long ways to go to turn more positive, even though we're still in an uptrend here. Some inflation gauges that we look at. We have a monthly chart of the CRB index, which are commodities on top, and it's been seeing some weakness lately, but it's still above its moving average in the long term. We'll look at a daily chart later. Then down below is a ratio between inflationary areas versus deflationary areas. And this had been coming back up as the market was getting more concerned about inflation. And it's still going up, but it's slowing down a little bit here on this monthly chart. Then we look at the CRB index. This is a daily chart where it had been in a solid uptrend. Now it's starting to pull back and actually drop below its 50-day moving average. We look at the Baltic Dry Index, where typically when this is going up, it costs more to ship products, specifically in the Baltics. When it's coming down, that's more deflationary. Well, we're chopping around quite a bit, but we're still in a longer term uptrend on this chart. Some other markets. We don't trade these markets. We just kind of keep an eye on them. I just look at them about once a week. There's other markets that I'll look at if something's happening or some news is breaking about that market. But here's aluminum, where it is in an uptrend. We're seeing corn in a downtrend, but it's been bouncing back up. Wheat is also bouncing back up. It's still in a downtrend. Fertilizer has been declining lately. Oil, which really spiked up when things were developing in the Middle East, now it's calming back down and actually dropped below 80. Gas, which is still in an uptrend, even though it's been pulling back recently. This is diesel, which has overall been declining lately. Heating oil, which is starting to come down and is in a downtrend. Natural gas, which has been under a lot of pressure, it's trying to bounce back up, but it's still in a downtrend. Copper, which is more of a barometer of the economy, it's still in an uptrend and actually doing quite well lately, even though it did pull back a little bit over the last few days. It was up in Friday's session. Then we look at a copper to gold ratio, where copper had been really underperforming gold. Well, now it's starting to really outperform as gold has been seeing a pullback where copper has been seeing some strength. We look at that on a longer term chart. That's the black line here, going back to 1980. And then I also plot a 2-year yield and a 10-year yield here, where we're kind of getting far apart again from these two, but we're seeing a little bit of an improvement with this overall ratio. A really healthy look at this would be from 2012 up to about 2016, where they were not too far apart, even though they're on different scales, and they were tending to go in the same general direction. We've been spreading far apart and actually for a while going in opposite directions as we're shifting more economic environments, especially since the COVID lockdowns. We look at gold, which is still in an uptrend, but it has been pulling back. Silver is also in an uptrend, but has been pulling back. And we have the closing value for gold and the closing value for silver. And then on the bottom, we see that there's a pretty high correlation between the two. Doesn't mean they're going either up or down. It just means they're going in the same general direction at the same time. Then we have the gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And then we have the US dollar index down below. And sometimes when we see a high correlation between the top chart and the middle chart, that can give us some insight about what's happening with the dollar. Right now, we're just around the midpoint. So this relationship between these two charts is pretty much neutral currently and has been for a little while. Here's the dollar, which had been strong. It got above 106, but since then has been pulling back. We're into the high 104s now, but we're still in a longer-term uptrend. And we're also breaking out above this trend line, but we have been seeing some recent weakness. We look at the euro, which has been chopping around quite a bit lately, and then down below is the dollar index. And then we also plot the Japanese yen, which really has been bouncing lately, but it's still in a longer-term downtrend compared to the dollar. Then I have some breakout charts. Here's the euro to the dollar, where we've been seeing a lot of weakness in the euro, but it has been coming back as we've been seeing some weakness in the dollar, but it's still in a downtrend. Here's the Japanese yen, which has really been bouncing up, but it's still in a longer-term downtrend. The British pound's getting close, but we're still in an uptrend here, and it's been bouncing back a little bit against the dollar. Then some index ratios, and I show this in the daily chart. This is the S&P 500, which is a weighted index, meaning the bigger companies have more of an impact on the movement of the S&P 500. Well, to make it a little more fair, we also look at an equal weight S&P 500, where all stocks are treated the same, and we can do some comparisons between the two. We're not seeing anything all that out of line right now. We've been really choppy with the ratio between these two. And then we look at the equal weight with the S&P 500. We kind of invert the chart here. Well, you can see this has been chopping quite a bit as the equal weight for the most part has been underperforming as the big mega cap stocks have been outperforming, but they're not really showing a lot of conviction right now. Then we do a ratio between stocks and commodities, where we had been seeing some weakness in stocks, but now we're seeing it come back. We saw some strength in stocks this past week and some weakness in commodities, so that's why this ratio is going back up. Here's an inverse of that same chart showing how commodities had been bouncing up, but now have been pulling back compared to stocks. We look at a ratio between the NASDAQ 100 and the S&P 500, and both of them have been having pretty good years. Recent weakness, though, and we're finally starting to see the NASDAQ 100 begin to outperform the S&P 500. We want to get above these lines and see these lines turn back up to show that the NASDAQ 100, which is pretty much all growth, compared to the S&P 500, which is growth, and the NASDAQ 100 stocks are in the S&P 500, but there's more stocks and there's more value in the S&P 500. Then we look at the S&P 100, which is really outperforming the rest of the S&P. That ratio is pretty strong now. The NASDAQ compared to the S&P 500 had been showing some weakness, but now has been coming back, still in a longer-term uptrend. The NASDAQ 100, the biggest stocks in the NASDAQ compared with the rest of the NASDAQ, it's still underperforming, and we're actually getting close to seeing a death cross with this ratio. We'll want to see, is the NASDAQ 100 showing weakness, or is the NASDAQ itself showing a little bit more strength? So we'll want to keep an eye on this. The mega caps, the really big companies with the equal weight ratio, they had been seeing some weakness. Now they're starting to bounce back. The mega caps are still outperforming longer term. Then we do a ratio between small caps and the S&P. That's the red line. This is continuing to decline and is just showing how small caps are underperforming. We also see that with this more direct ratio here. This is in a downtrend. We're bouncing back up. Small caps had a fairly good week and finally turned positive on the year, but still are really continuing to underperform. The big software companies, they're showing a little more weakness. They actually dropped below their 200-day moving average and are having a hard time getting above that, even though they're still in a longer-term uptrend. The mega caps been pulling back. Earnings reports have been coming out, been fairly well received. We're starting to bounce back up, and now we're dealing again with the 50-period moving average with the mega cap growth ETF. Robotics is seeing a little bit of a bounce here. We're coming up to the high end of the rainbow. That's kind of all the rage these days. And we're actually seeing it possibly begin to outperform the tech sector when we do a ratio. If we could get above the rainbow, stay above it, and then see these lines turn up, that would be more positive for robotics and AI. The Dow Jones Composite Average, pretty much all the strength we've been seeing, a little bit lately in the utilities because they had a good week, but mostly it's been coming from the Dow. The transports have not been helping at all. We're coming back up to the 50-period moving average, and you'll see that on a lot of charts right now. That's a real line in the sand between positive and negative, especially in the intermediate term, and the market's just camped out there after Friday's session. Here's the S&P compared with bonds. Had been seeing stocks pulling back, and now they're starting to show some improvement. Here's a broader market measure of S&P 1500 stocks compared with shorter term bonds, also starting to show some improvement. Here's another broad market measure with further out bonds, continuing to show some improvement. Total US stock ETF coming right back up to its 50-period moving average. Low volatility stocks, when you look at them by themselves, they're in an uptrend. Even though they fell below their 50-day moving average, they're pretty much back to their 50-day moving average now. But when we compare them with the performance of the S&P, they continue to really underperform. The tech sector continues to show a little bit of improvement here when compared to 3 to 7 year bonds after we had been seeing some weakness. Then some other stocks that we look at, and I show this in the daily video as well. This is more broad market advanced decline line studies where we look at the NYSE common stock coming back above its moving average. Then we look at the S&P showing some improvement, mid caps and small caps. So we are seeing some more broad market improvement here. Then we look at Dow theory where we have the Dow on top, and it recently set all-time highs. You can see the transports, they're really lagging. They were going sideways at best and even then declining and not really bouncing back yet. We want to see the transports doing better. That would really help the overall market condition. The utilities have been chopping sideways, but lately have been really showing some improvement. Here are other transports. We're not even back to these previous highs that we've set. And they've really been languishing lately. We look at a ratio between the transports and S&P. When this is going down, that means that the transports are underperforming. We look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And then the relationship between the S&P and the transports, not really strong right now. The S&P has been bouncing back. Transports haven't been doing all that much. They've been improving, but not as much these days. And then we have a new take on Dow theory. Instead of using the Dow, why not use the S&P 500? And down below, instead of using the transports, why not use the NASDAQ, which is tech? And we're not really seeing much. The only thing that I notice here is we're not back to the previous high with the S&P, where we did fall down below the previous all-time high with the NASDAQ. Now we're starting to come back above it. So this chart is showing some improvement. Then we break it down a little bit more. Instead of using the S&P 500, why not use an equal weight S&P 500 index? And instead of using the NASDAQ, why not just use the QQQs, which is the NASDAQ 100, and use an equal weight ETF? This has been underperforming. We're coming down under this previous all-time high here, where we're still above the all-time high with the S&P 500. So we're seeing a little bit of negative divergence here. The Wilshire's right back to its 50-day moving average, and this is a broad market measure. The FANG index is a little bit above its 50-day moving average, and that's just because these big stocks like Facebook, Apple, Amazon, Netflix, Google, NVIDIA, the big ones, they've been showing some improvement lately. And I just keep this chart around in case we really start to decline to see if we find some areas of support. But right now, we've been going back up. ARC, which continues to really struggle right now. It's still in an uptrend, but it's rolling over. It dropped below its 200-day moving average. It is bouncing back a bit, but it's got a long ways to go to get back to the darling state that it was in a few years ago. And we look at a monthly chart of the S&P 500, and we compare that with stocks in Europe, Australia, Asia, and the Far East. When we're above this red line, that means the S&P is outperforming. The red line's going up and price is above the red line, even though lately it's been pulling back. We also look at a momentum oscillator below where it's rolling over a bit, but we're still above zero. We look at bonds. This is a daily chart of the total bond ETF where we've been really under pressure. We came down to the 200-day moving average. We're possibly bouncing up off of that. And if this goes up, that means interest rates are going down. And the world bond index, man, bouncing around like crazy here. Still in an uptrend, but if we stay below these lines, we could see a death cross based on price here pretty soon. When we look at a monthly chart of stocks versus bonds, stocks are still outperforming. Here's a daily chart showing the inverse of that, continuing to show how bonds are underperforming stocks. So we have a long-term look on a monthly chart. In the weekly video, I go through weekly charts, and here we have another daily chart. They're all confirming each other. These are high-yield bonds, known as junk bonds, coming back and actually starting to set new all-time highs with this ETF. Investment grade bonds still have a ways to go to get back to their all-time high, but they're still in an uptrend, but they came down to their 200-day moving average and possibly now bouncing up off of that. And we look at riskier bonds, junk bonds, versus conservative bonds, government bonds, still showing that the riskier bonds are more favorable. Folks are willing to take on more risk to get a better return. And we look at a correlation between stocks and bonds. For a lot of the last part of April, we were neutral. Excuse me. Now we're starting to see where stocks and bonds are correlating a little bit better with each other. And if we can see that in this kind of an environment where stocks are going up, bond prices are going up, that means interest rates are going down. That could be more healthy for the market. And we look at the Dow Jones Corporate Bond Index. It's been going sideways, still in an uptrend, but has not been able to get above its 50-day moving average. Here's the 10-year yield with some Fibonacci lines on here. Really nothing that we're hitting right now. This is a long-term chart where we could possibly be shifting into a higher interest rate environment, where for a long time we were seeing a gradual lower interest rate environment. And that's just, we're keeping an eye on that. This would actually be reverting back to the real normal, where what we've seen over the last 40 years is not normal. And then this is a chart that I've been showing for a while. I'm not sure how relevant it is right now. When we hit that 5% level back in October and then bounced up off of that, this was when the market developed this Goldilocks scenario, that there was going to be a soft landing, that the Fed was going to start cutting rates. Everybody was happy. Stocks really started to go up. Interest rates really came down, and things were looking a lot more positive. We don't know where we're at in that whole scenario right now. The market had gone away, that whole scenario. Then it came back again. Now it's kind of in question now, as we've been seeing stronger than expected economic reports. But this is considered to be something positive, where the other two events, when we had extreme negative readings here, these were negative things that happened. So I don't know how much longer I'm going to show this chart because I'm not sure how relevant it continues to be. Here's another Fibonacci chart with the 30-year yield not really hitting anything right now. Looking at the S&P compared with the 10-year yield, where we had been pulling back, now the S&P has been starting to outperform again slightly. This is 3 to 7 year bonds compared with stocks. This is kind of an inverse of what we just looked at, showing how bonds have been underperforming. As interest rates were going up and stocks were going down, we saw this ratio pick back up, but now it's starting to come back down. Junk bonds holding up quite well. And if not they're at least close to a new all-time high. And we look at a ratio between junk bonds, which are outperforming government bonds, and they've been doing that for quite a while now. When interest rates finally top out at some point, and who knows what it's going to take to get there and how long it's going to take, then we'll finally start to see this ratio coming down. And there's been a lot of false starts along the way, thinking that maybe interest rates have topped out. So then folks get out of the junk bonds, which are riskier. They get into government bonds thinking that they can lock in a good rate for a long period of time, only to have that scenario dashed. And then we turn around and people are getting back into junk bonds again. Well, that's kind of what we're still seeing right here. Look at the 7 to 10 year bond ETF. This is bonds based on price. We finally were able to get back above the 200-day moving average. We're still on a longer term uptrend. The RSI is trying to get back above 50, and the momentum is trying to turn positive. So maybe we're seeing some hope here with bonds based on price. This is a daily chart where we had been going up with interest rates, and then we've been seeing them drop off lately. Here's a weekly chart looking internationally, where we did see a decline with US and UK rates, which are the highest, a little bit of a decline with German rates, and even Japanese rates ticked down in the previous week. We look at the MOVE index on top, which measures the volatility of bonds, then the VIX, which measures the volatility of stocks. And right now they have a pretty strong correlated relationship. Now this just measures volatility, not direction. So they're both, if volatility is dropping for bonds right now, it's also dropping for stocks right now too. We'll look at a monthly chart of the 30-year ETF based on price, where it's been going down based on volume, and it has been going down, and it's below the moving average, and the moving average is declining. But when we compare it to commodities, it's still going up on this monthly chart. And we look at different sectors, and I changed this a few months ago with how I approached this section. First, I show a chart just of the 11 sectors of the S&P, to look at them by themselves, and then I compare them with the S&P. And I just rank these according to their symbol, and it's alphabetical. So there's nothing special about this. The first sector are materials, which continue to be in an uptrend, still having a little trouble getting above their 50-day moving average. But when you compare it to the S&P, they are underperforming. Communication, getting back up to its 50-day moving average. And this has been a stronger area, and it's trying to get back above this other 50-period moving average with the ratio. If this could really go back up, that would give more support to the market. Energy, which had been doing quite well, actually dropped below its 50-period moving average, but it's still in an uptrend. And it had been starting to outperform on a ratio basis compared to the S&P, but lately has been pulling back. The financials, which have been doing okay by themselves, a little bit under their 50-day moving average and in a longer-term uptrend, and doing okay with the ratio. They were really starting to outperform, but lately have been pulling back, but they're still in a longer-term uptrend compared to the S&P. Industrials, which are also dancing around their 50-period moving average, they have been outperforming the S&P, but lately have been falling back. Tech sector, underneath its 50-day moving average, and had been starting to underperform, still in a longer-term uptrend, but could be starting to show some improvement. But they have to get above this 200-day moving average first. The staples sector, which when you look at it by itself is in an uptrend, even though it did pull back, and then it got back above its 50-day moving average, and it came back down. Now it's a little bit above its 50-day moving average. These are things that you have to have no matter what's going on in the economy. But when we compare it to the S&P, staples are underperforming. Real estate, looking at it by itself in an uptrend, even though we've been seeing some weakness, still having a problem getting above its 50-day moving average. But when we compare it to the S&P, it continues to really underperform. Utilities in an uptrend, when you look at them alone, when we compare them to the S&P, still in a downtrend, even though they have been bouncing back lately. And then we look at the S&P to utilities ratio. When this is going up, the S&P usually is going up. When this is going down, that's when the S&P is usually going down. We want to see this ratio turn and go back up to be more positive for stocks. Healthcare, you have to have that no matter what's going on in the economy. Below its 50-day moving average, when we compare it to the S&P, really underperforming. This is more defensive. Discretionary, the things that make life fun, having a little trouble getting back up above its 50-day moving average, and is underperforming when we compare it to the S&P. In 2023, this area had been doing a lot better and was giving a lot of support. A lot of this is being dragged down by Tesla. And if things could improve with the discretionary sector, that would really help this and give more support to the market. Semiconductors fell down below their 50-day moving average, came back up, fell down below. Now they're starting to try to recapture the 50-day moving average again, all by themselves. And we look at another ratio of energy, which had been really outperforming tech. Now we're seeing tech doing better and energy seeing some weakness. So this ratio has been coming down. We look at growth stocks, compare them with bonds, showing that growth stocks are still outperforming the price of bonds. The tech sector with the 10-year yield had been outperforming, saw some weakness as the tech sector was weakening. Now it's possibly starting to show some improvement. Here's an inversion of that same chart where the 10-year yield had been rising up, but lately has been falling back. Discretionary to staples. In a good positive environment, we want to see discretionary outperforming staples. We're getting ready to see a death cross with this ratio, meaning that discretionary is starting to underperform staples. And we're seeing pretty much that same thing with the staples to discretionary ratio, where staples are starting to outperform. Gold to the S&P, we're starting to see a golden cross here when we compare the price of gold with the S&P 500, where it had been underperforming. But now we're seeing some weakness in gold, so this ratio has been coming back down. And we compare gold to the dollar, where gold had been breaking out against the dollar, but as we've been seeing some weakness in gold, we've also been seeing weakness in the dollar, but this ratio has been coming down. High leverage loans. This is an area where I always say this, if the economy was getting ready to fall apart, there's a lot of smart people that invest in this ETF, and they know a lot about what's going on because these are very risky loans. Would we be breaking out above the 50-period moving average? Probably not. And so this is giving support to the rest of the market. It's been holding up a lot better. Where stocks have been bouncing around a lot more, this ETF is more of a sustained uptrend. And we look at the NYSE composite, which is just a little bit under its 50-day moving average, a broad market measure. All stocks, looking at US stocks and international stocks, starting to break back above their 50-day moving average. Emerging markets showing a little bit of an improvement here and still in an uptrend. The Japanese Nikkei index, where it finally broke through the high set back in 1989. And since that time, it's fallen back below that new all-time high. The micro caps, very small stocks, still in an uptrend, trying to come back up to their 50-day moving average. We look at it, the home builders compared with the S&P, and I do a ratio down below. We're not really getting any insight from this chart. We're looking for negative divergences. When this correlation is as strong as it has been, we look for these yellow areas here where they're really diverging from each other, and that's just not happening right now. Here's Bitcoin, which finally had broken out. It's still in an uptrend, but it's been falling back. Over the weekend, it's been bouncing back up into the 60,000 range. And we look at internationally, where China has been doing quite well lately. It's actually in an uptrend. And I use a thing called the KST momentum oscillator for this. We're seeing some improvement in the emerging markets. Europe could be turning positive. Japan could be turning positive. And we're not quite looking as strong here with the S&P, but we could be turning positive in the US as well. Intermarket analysis. Oil is still in the lead going back to the beginning of the year, even though it has been declining. Then we see gold, then stocks, then the dollar, where bonds based on price are negative on the year. Then some correlations. We compare the S&P 500 with the dollar, where they're having a slight tendency to go in opposite directions. So if the dollar is going down, that's been giving support to stocks. And we look at oil, where that had been acting up as there was unsettled things going on in the Middle East. Now it's coming back down to a neutral reading. So we're not going in the same direction or in the opposite direction currently. We look at the S&P with the 10-year yield, where they're having a slight tendency to go in opposite directions. So if the 10-year is going down with yield, that's giving some support to stocks. Not much, but some. And we look at tech against the 10-year yield. Also, not a lot of support, but a little bit if interest rates are going down. Now, the inverse of that also works. If interest rates are going up, that could be putting pressure on the S&P and the tech sector. And then we look at the 2-year yield compared with the S&P. They're having a pretty strong tendency to go in opposite directions. And we look at some long-term charts. This is a monthly chart of the NYSE. We're above the moving average, and we did have an up week this past week. The longer-term momentum continues to be positive. Here's a daily chart of the NYSE, where we look at a thing called the NYSE record high percent index. That is continuing to go up, and it was ticking down just a little bit, but could be seeing some signs of improvement. This is a daily chart. And we look at the S&P on a monthly chart. It's above the moving average, so longer term we're positive. We're rolling over a bit here with the percentage price oscillator. We want to see that turn back more positive. And we look at a ratio between the S&P stocks and the CRB index longer term, where stocks still continue to outperform commodities on a longer term basis. Then we look at another ratio between the S&P and a global index. The S&P is still outperforming. The KST is pretty much flat right now with the momentum. Then at the very end, I go through the list of positive things, and this list is pretty long. The negative list is still pretty short. My definition of positive as it applies to this video is when the 50-period simple moving average is above the 200-period simple moving average. So we have the growth indexes by themselves, the value indexes by themselves, copper, the British pound compared to the dollar, gold, silver, the dollar, the CRB index, the big software companies, the mega caps, the FANG index, ARC, low volatility when you look at it by itself, staples, the Dow Jones Composite Average, bonds based on price. The world bonds are looking a little iffy right now, but the other ones are still holding up a bit better. The tech sector, as well as the semiconductors, high leverage loans, the Dow, the NYSE, and the Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. All stocks, emerging markets, and then I'm running out of room, but there'll be Bitcoin there at the bottom. Then we look at the negative things. And this is when the 50-period moving average is below the 200-period moving average. And this list is pretty short. We have the Japanese yen to the US dollar and the euro to the US dollar. Thank you. I hope you found this helpful. This is not meant to be a standalone video. I do this in conjunction with the other videos that I also post. So to get the most benefit out of this, it would be to your benefit to watch the daily videos and weekly videos if you have time to do that. So have a great weekend, and I will talk to you in the next video.